Good afternoon, everyone. Welcome to our program, Funding Your Business. We will initiate the program in approximately 5 minutes. Give people time to sign on. So if you just bear with us, thank you. And good afternoon, everyone. I will be starting the program in just about 2 minutes. Appreciate your patience. Yeah, good afternoon, everyone. Welcome to this afternoon's program, Funding Your Business, which is being sponsored by your local SCORE chapter and being presented by Hudson Valley Credit Union. This afternoon's presenters are Carmen Carroza. Carmen has been in the retail banking industry for over 30 years and also runs his own coaching business and internet radio program. Carmen currently serves as Assistant Vice President of Sales and Service with Hudson Valley Credit Union. Also presenting is Diane Elias. Diane has been a commercial lender for over 20 years and has been working with business owners in various industries for more than 35 years. Diane is a business loan officer also with Hudson Valley Credit Union. Before we get started, just a quick housekeeping note. If you have any questions, please enter them into the Q&A box and we will make sure we answer them either during and or after the presentation. So without any further ado, I'll turn it over to Carmen and Diane.
Thank you so much, Bill. It's a pleasure to be here. I hope everyone is having a great, cool day here in mid-August. And I have with me Diane Elias. Hi, Diane.
Hi, how is everybody today?
Good to have you with me, and we will get started right away. Let's get started on talking about all the different opportunities there are for lending in today's world as best we can. So we're going to start with one of the simple things that's pretty obvious, but we like to talk about it, and that is credit card. Of course, they should only be used normally for short-term needs. If you're confident that you'll be able to pay off the balance at the end of the month, that's great. If not, there are cards that will go on an installment basis, but many of the business cards are month to month. It's good to look at the internet and find out, Bank of America, Chase, they're going to have all the bells and whistles if you're looking for that kind of thing. The only thing you've got to be careful of is fees. They can be very expensive. So Amex cards can be anywhere from $50 to $600 a year. And, you look at also rate, look at what the terms are. Again, on a month-to-month basis, if you're late, are there going to be any charges? Will they up the rate on you? So again, those are the cards with all the bells and whistles. But then if you go to your local banks or your regional banks, often they will have cards that are more simple. They might have rewards attached to them. With the major cards, of course, you're going to have either fuel or air miles, cash back, rewards, all those types of things. But with the local cards, you can get rewards and might get gift cards and things if you reach certain points. But the key is get a card that fits you best and doesn't cost you a heck of a lot, especially based on where you are. If you're a startup or if you're a very small business, you don't want to have that extra expense. So that's kind of the credit card world. We'll go on to talk about lines of credit. And Kate, if we can move right on to that, thank you so much. Lines of credit are one of the more useful products, lending products there are for businesses. And if you've had one, you know what I'm talking about. Lines of credit are basically very flexible. I've been in banking all my life, and I'm telling you now, you get a line of credit whenever things are good, or you're starting off. Whenever you can get a line of credit, I think it's very important to get that. It helps with a lot of different things, seasonality, a lull in cash flow. If you're looking to fill some gaps between your receivables and or inventory, purchases, things along those lines. So lines of credit are a real important aspect to every business, small or large. Now, there's some things to know about them. Or one, of course, they are usually it's a variable rate. So the rate can change based on certain criteria, treasuries and things along those lines. The other thing to know about them, based on the size of them, if they get larger, there could be a cleanup period. And a cleanup period generally means that for 30 days during a calendar year, that loan has to be off the books. Meaning, in essence, and that's the terminology you hear from a banker. That means you have to pay it off for 30 days. They want to make sure you have some liquidity, and they'll look at that on an annual basis. On smaller lines, generally that doesn't happen. But again, you got to know your product when you apply for a loan to find out exactly what you're applying for. And these are good questions to ask to make sure there's no time period where it terms out, things along those lines. So just be sure you ask enough questions when you're talking about a line of credit. But it's a very important piece when you're growing, because when you need funds quickly, this is the best way to access them, rather than at that point going to the bank, and if you're turned down or things don't work out, trying to find access to cash could really determine where your business goes at that point. Now we'll move on to talking about term loans. Term loans obviously are fixed loans generally for a certain time period. So those you can access, the funds are given to you right at the point of application and funding. And then you're basically amortized over 3 years, 5 years, and I'm hearing today there's some banks out there going further than 5 years, up to 7 years. We got to be careful of that. And the reason term loans are in place are they're more for fixed assets, equipment, trucks, vehicles, supplies, renovations you're doing and if you own a building or you're leasing a building and you're creating some more space, things along those lines. So that's what a term loan generally used for, and it's used specifically for the purpose of to match up with your tax implications, because your accountant will look at certain aspects of machinery, equipment, vehicles as being depreciated over time. So that's why a term loan matches up with your tax implications that are very important to your accountant. So it's important always to include, as we'll talk about later, either your accountant, your financial consultant, but someone who really looks at the big picture for your business to make sure you're doing the right thing and that the payments are within your scope. So those are some of the aspects of term loans. Anything to add to that, Diane?
Again, I think it's just a matter of matching the right product for the use of funds. And that's really what people have to be thinking about when they're thinking about determining what they, need as far as a term loan or a line of credit, or when it's applicable to use a credit card even.
Yeah.
And so long as the first thought that you want to have is, what am I going to use the funds for? And if it's going to be for short term, which is 12 months or less, then you want to use a line of credit for that acquisition or that purchase. If it's going to be something that you're going to hold, some kind of piece of equipment, as Carmen said, or a vehicle or something that has got a longer useful life, okay, then you would match that with a term loan with a useful life and then the term of the loan. So again, vehicles, as we know, can be 60 months, but there are vehicles that they will give you for 7 years.
Yep.
And in fact, depending upon the size of the equipment, very large pieces, very expensive pieces of equipment can actually be termed out up to 10 years.
Mm-hmm.
So we match the type of loan and the term of the loan to the use of the asset or the item.
That's a very important point, Diane. I'm glad you brought that up, because each one of these products, many businesses have all three. The credit card is for their everyday expenses. They may use it for everything from staples to gasoline and it's a great way to track your expenses from a business point of view. So you're not looking all over the place for receipts and things along those lines. And then your line obviously is for either seasonality, cash flow. Again, less than 12 months is how we always look at it, short-term needs. And, that's almost like, you think of it as petty cash. You use it, you got to pay it back, rather than taking the whole thing. Once you're thinking that way, that you're not going to be able to pay it back, you got to look at a term loan. We see many, many times in the banking industry, folks come in and say, hey, I need a line of credit. They're buying a vehicle or something along those lines. And, we have to explain to them why that's not the right product for them at this point. So always just make sure you're asking the right questions and you get the information you need from your banker, the credit union, wherever you're dealing with. And then again, always talk to your accountant to make sure it's the right product or service. We're gonna move on. We're gonna talk about some things along the real estate line, and I'm gonna let Diane take you on that journey right now. Go ahead.
Before we do that, I have a few questions relative to your initial topics.
Sure, Bill.
First one is, are credit cards or line of credit available to a small business, or do they use your personal credit history?
That's a great question, and they do use your credit history. Most credit cards, lines of credit, will affect your personal credit, especially credit cards. And it's a question always to ask your banker if they're going to run it personally. And credit cards, they normally will. And yes, they are available to small businesses, and differentiate that. Sometimes you'll see a corporate card. Corporate cards usually have high fees, are very expensive, where if you're a small business card, usually don't carry the same amount of expense and fees to it, if that helps.
And I would also add to that, a good way for new businesses, young businesses, startups, or even companies that may have been around for a little bit but still don't have any credit, any business credit under the business name. Something that you can do is you could take a small amount of money, even if it's a couple $100s, go and open up an account at your local bank and ask for a term loan for the same amount of money. So if you put $200 into the account, take out a $200 term loan and pay that off in a 12-month period. And that will help you establish business credit so that if you can't get a line of credit or a credit card, that will allow you to help you start building a business credit score, so to speak. And a lot of people say, well, I don't always have a lot of money. Again, start small then, but it certainly will help you build business credit.
Absolutely, Diane. And you could do the same with a credit card. You can often get a secured credit card if it's available at your institution, financial institution. And again, that's an easier way to at least get the card in your hands and start to build your credit.
The second question, Diane, you just touched on this a little bit. What are the best ways to obtain credit when you are a new business with only a year or two under operation?
I'm going to go back to how to establish would be the way I just explained, by establishing an account and paying it off on time, and making your payments timely, that they're not late. That will help you establish credit. But when a new company or business wants credit, you have to really have a reason for it. You don't want to necessarily take out debt unless you actually need it. So when you know you believe you're going to be needing credit, that's when you start to talk to your financial institution that you're working with and talk about, once again, what is it that you want to do with the money? Hi, Mr. Banker, Miss Banker, I want to do this. I want to buy this. I need to, whatever it is, if it's materials for a job, if it's a piece of equipment for, to be able, because maybe the equipment that you have, is not functioning properly. Depending upon what you are trying to do with the funds, you don't necessarily need to know what type of product you need. If you know what you want to do with the money, the banker should be able to help you find the right product that will, match and suit what you're looking to do.
And I'll just add, Diane, that under most financial institutions, if you're not in business for 2 years, to get a line or to get a term loan is a challenge. So the best way is usually to start with either a credit card or a secured line of some type.
Okay.
And there are SBA products we'll talk about later that may help too.
Next one, for an average line of credit, what is normally the payback time following a draw on the line of credit?
On a line of credit, the payback, there's no set, the good news on a line of credit, especially smaller ones, there's really no payback time. It's really up to you as far as use and paying it back, because remember, most of them, you're going to pay interest only. But you can get yourself, again, at a point where you're paying a lot of interest if you don't pay it back. So let's say you have a $100,000 line and you use $80,000 and you don't pay back the principal. You're going to be paying interest only, but you'll be paying that for a longer period of time, and you'll still owe that principal. So you got to be careful with a line of credit of extending yourself too far, because that's where a lot of companies fall into problems.
And once again, and Carmen, you're right. And once again, this goes right back to what I was saying before. if you're using a line of credit and you're using it properly and the use of funds is to purchase materials for a specific job, or if you're purchasing supplies, again, that may be related to a job or that you use on multiple jobs. In theory, what you're doing is you're buying something today that you're using over a shorter, over the short term, over the next month, week, days, and then you're going to get paid for the services that you provided or the item they purchased from you. And with that money, you should be going in and paying down that line immediately. Because once you don't do that and you put it into your general funds, you have a tendency of just using it for other things. And what happens is that line of credit that's now extended is what's called now permanent working capital. And that's really not your equity in, that's somebody else that's giving you money that's really has a use associated with those funds, meaning you're supposed to take that money and pay down that line. So although it's an interest-only facility in most cases, some banks will have some that are hybrid where they have you pay, say, 1% of the principal, but the vast majority of these types of lines they're only going to bill you interest only, just like a credit card. And what's going to happen is if you don't, have the right thought process when you're using these types of things, you're going to get yourself, this is what Carmen is saying, in trouble, and you're going to end up fully extending your line. You're never going to be able to pay it down, and now you're going to have it termed out. The bank will automatically term it out with you at some point. And by the way, because because this line of credit will be basically unsecured because there's no collateral for that loan, you're going to pay a very, very high interest rate. So it's really not in your best interest to allow that line to be extended too far without taking time to realize you need to pay it down on your own, because no one's going to force you to do it.
Another quick question here. Do they run my credit for a term loan?
Personal credit is always pulled.
Yep.
Yep.
For
And
all.
any of the 20% or over, right, owners?
Right.
Yep.
And one last one, and we'll move on, and then we don't capture, we'll pick up at the end. In regards to term loans, what are the requirements for nonprofit organizations for a term loan? Is the credit of the top executive used to obtain the loan?
No. It's all about the cash flow and ability to pay.
Yep.
Okay. Okay. Well, we can pick up the rest of these questions toward the end. Then.
Great. Okay, Diane, you want to talk a little bit about commercial and real estate?
Sure. So, there are so many things. The first thing that you want to know is when you go outside and anything you can see, any building you can see or any land you can see can be, the security or collateral for commercial loan. So that means you could use a 1 to 4 family. It could be a multifamily, which is something that's above 4 family. Okay, that's when you start to get into true commercial property. Anything above five families or more is considered commercial property, and you must use a commercial loan. On a 1 to 4 family, you could in fact use either an investment residential mortgage, or you could use a commercial mortgage. Most times you would want to use probably a residential mortgage, just because the rates and terms are typically a little better than commercial, but they can be used. Both types of loans can be used. Then you have your retail or your commercial buildings. They can be owner occupied, they can be non-owner occupied, industrial, warehouse. You have what's called mixed use or multi-use. Multi-use is where it's a mixed use of different types of businesses. Mixed use is typically considered retail on the bottom and then residential on top. So those are the different kinds of properties. And of course, there's always raw land. All of these have various types of loan to values depending upon the type of property you're trying to purchase. That will determine the loan to value. And as far as, you know, construction loans are concerned, keep in mind that everything is secured by a first priority lien mortgage. Okay, so the product is a commercial mortgage. Even on a construction loan, it's still a mortgage. If you're getting a line of credit secured by a piece of property, it's still a commercial mortgage. So there are different types of uses for the commercial mortgages. So you can have different types of products underneath that category, but there are certainly a number of properties that can be used with a commercial mortgage and different programs under that. As far as, you know, applying for a commercial loan, again, if you're an owner-occupied property, in many cases, we're going to be looking at the cash flow of the tenant, which is typically the operating company. If you're not looking for financing for a non-owner occupied property, it has maybe multiple tenants. Certainly, we'll want copies of those leases. We look at the standalone, what's called the standalone cash flow of that property. So we'll be looking at what is the income, what are the expenses, and how much is left over to pay the mortgage. So we'll look at it that way first, but banks are required to also do what's called a global cash flow. And that's going to take into consideration not only the property, but then anything else you own, any other corporations, anything personally. We take all of that information and then do all of the income together in a global sense and all the expenses on a global basis. And we look to see if all of the debts can be covered by all the income after expenses. So this is how bankers look at commercial mortgages, and in fact, actually how we also look at many times all types of commercial debt.
Great, Diane. That's you know, all entailing information. Thank you so much. As we move on to, we're gonna go to SBA products. Diane, want to talk a little bit about 7As and 504s?
Sure. I'm going to be looking at, you know, if you're looking at the same thing I'm looking at here, we're going to be talking about the 7A loan. These loan sizes are between 100 to say 5 million. Again, many companies that are considered startup or in expansion mode, you know, would be looking for an SBA 7A loan. These types of loans you can be used for a line of credit or a term loan. You can also get a commercial mortgage using an SBA 7A. But again, every situation is different. So we will be looking to see what it is that you're trying to do. If you're looking for multiple things, someone needs to pick. And again, you always want to check with the person you're working with to find out, you know, which loan product is going to be best for you for that particular, whatever you're trying to accomplish. So these slides here are going to give you some basic information. When it comes to your term loans, again, they can be up to 25 years for real estate. So that's your amortization schedule. 10 years, meaning amortized for 10 years for business acquisitions, equipment, larger pieces of equipment now, and leasehold improvements. Up to 10 years if you're looking for franchise. Use examples of the use of the proceeds can be for all of these items here to purchase real estate, debt consolidation, leasehold improvements, equipment, and business acquisitions and startups. Again, the working capital is really a line of credit is what they're referring to there. The collateral, again, you can get up to 90% financing on real estate transactions. Special use properties, which would be something like a church or a gas station, a hotel or motel would be 85%. Multi-use or property which again is your office, retail, and warehouse. That would be up to 90%. Single-use properties, hotels, again, these are going to fall into the 85% use. The SBA, again, is looking for, as far as collateral, they're going to look for 60 to 85% loan to value that they will finance. Startup businesses will generally need a third, of funds to put into the transaction. And I apologize, I timed out here. Okay, I got to keep moving that cursor.
I know what you mean.
I get so caught up in the pictures here. Okay, so now on the construction loans. Again, for ground up construction, they're looking for the business to occupy 67% of the building. And that's a requirement of the SBA. Funds can be used to cover both construction costs and soft costs associated with the project, including the cost of land, building, and construction. And then, of course, the construction loan will automatically convert into a term loan once the project is complete.
So what happens on a construction loan, if I'm correct, Diane, is there's certain stages that you'll receive funds once there's an inspection, everything is approved, and then you'll receive partial funds per se until you complete the project, and then it terms out.
Yeah, and I'm going to say construction lending in general, if you're not aware, is probably the riskiest type of loan that a bank can do. And you really, really have to have a good amount of cash behind you to be able to do a construction loan, because there are a lot of costs associated. And in many cases, when you're looking for advances, you actually have to pay upfront for the work to be completed and installed. So if you're building a building and you've ordered windows and the windows arrive, and when they get there, you have to actually pay for those windows when the vendor delivers them. You're going to have to pay that out of your pocket and install those windows. Once the windows are installed, you might call for what's called an advance or an inspection and request, hey, I need my $75,000 that I just put out for all those windows. An inspection is done, and then we will advance the funds once those products are installed. So we don't advance until it's done, the work is complete, and the item is installed. You will need to have cash on hand to be able to do these types of projects.
It's a great point, Diane. And then 504s.
The 504 program is really the one I probably use the most because, again, I seem to get an awful lot of commercial real estate requests. I would say I'm probably most versed in this particular product, although the others I've used for many, many years. But the 504, again, allows you to get up to 90% financing. The SBA will contribute 50%. We will contribute 40%. I'm sorry, SBA is 40%. The bank is 50%, and the borrower is 10%. And you can get up to 25 years in an amortization schedule so that those payments, the payments are lower and they elongate, obviously, the debt, but again, it keeps your payments down. In these particular cases, 51% owner occuy. For an existing building, if it's new construction, you have to occupy 60%. And they do require a personal guarantee of the owners. And again, personal guarantees for most commercial loans is anyone that owns 20% or more of a company. These are some of the basic things, that you would need for an application for most banks. You're going to need 3 years of your personal and business tax returns if applicable. Obviously, if you've only been in business for a couple of years, you'll only provide them maybe with a couple of years of your business returns. They still may want 3 years of your personal. You'll need your application, personal financial statement. Just so you know what the IRS 4506 is, It's just a form that some companies require that you complete, and we just validate that your tax returns were filed, and there are certain numbers that are validated on the tax return to make sure that we have collected the right tax return, because sometimes people do amendments and then they forget to notify us. So that's what the 4506 is really for. Additional documents that we could ask for: your accounts receivable and aging reports. Those are usually used for lines of credit. Inventory is also something that we'll look for, and again, lines of credit would be collateral, for instance. Current work in progress, which is also called a WIP. That's something where you're going to tell us, what projects you're working on and when they're going to be completed and what it's costing and what your anticipated profit on those jobs might be. Copy of an environmental appraisal, mortgage statements, deeds. These are all things, depending upon the type of loan that you're looking for and what the collateral is going to be, will be necessary to collect from you when the time comes.
And Diane, of course, these are, there's a big list here, and we don't want to make people crazy and think, oh my God, I need all this. But most of the time, this is for complex deals, commercial mortgages. When you're talking about lines of credit, term loans that are generally, let's say, under $100,000, it's usually more tax returns for the business and the individual, personal financial statement, receivables, things along those lines. Am I correct?
Yeah, and I mean, I'm going to say every company out there is different. And I will also say that larger companies like the Bank of Americas of the world, those types of companies actually have one-page applications because they're scored products. The one thing I will tell you is, with a scored product, you either get the loan or you don't, because there's no way for someone to just take a one-page application, not take any additional information, put that into a computer, and have any way to say, well, gee, wait a minute, we declined you, and you say, but this is why this happened, and this is why this happened. That doesn't happen on a scored product. The only time that you can actually explain what occurred in a particular year, if you have an issue, is by working with a lender direct, one-on-one, and not use a scored product, because then you're going to be able to explain what might have transpired in a particular year and why that year might have been not as good as another. But in a scored product, that doesn't occur.
Terrific, Diane. And, it's so important, and I'm talking as a banker for a long time, to build a relationship with your bank, your branch manager, whoever's there. And the reality is, there's often changes. Get to know the new manager if they come in, but it's important that they know you, they know your business, that they visit, and if they're not paying attention to you, it's time for another bank. I'm a big believer in building relationships with your businesses in your market. And if they're not paying attention to you, you should think about looking for another partner. But I say that from a lot of experience, because that's their job. They should be reaching out to you. You should be reaching out to them when you just want to throw something past them. If you're in a certain situation, there's changes in your business, there's changes in your seasonality. The way we're going through things right now, obviously, there's a lot of changes in businesses, the way they're collecting payments and making payments. So just a word to the wise. I'm going to just talk real quickly about a couple of different options that are out there. Microloans, when we talk about startups, someone asked about startups, this is an option for you, and this is sometimes an opportunity. Through the SBA, there are micro lenders, and they'll do loans for smaller amounts, and you can go right on their website. I think I put the link right in here to go to sba.gov, and their partners out there will help you. Now, it's a real important part of this, and we'll talk about this in detail later, but having a business plan. And we know that probably 90% of businesses don't do that unless they're told they have to get a loan. but it's so important to put a business plan together. But that'll help you as you start to look for lending opportunities. And then I want to touch upon these only because they're out there, people see them, they're advertised everywhere, but you really got to be careful with fintechs. And the fintechs just means purely financial technology lenders that are out there. Lendio, On Deck, Cabbage, PayPal has just entered that world. Fundera, those are some of the bigger ones. There's a ton of them out there. But I'm going to give you a big but here. You got to be very, very careful with these lenders. Their rates can be astronomical. If you look at their sites, they'll say from 15% to 80%, which is unheard of in the banking world. The fees that can be involved, penalties, if you prepay or pay the loan off early, you got to be very careful about that. And also if there may be fees if you miss a payment or you're late. They may up your rate from 10% to 30%. So I put them out there purely so you know they're there, but really from a perspective of don't use them unless your accountant, your financial people feel this is the right way to go for certain funds. But in general, I feel just be very, very careful about these types of online technology companies. They're very popular. And then some investing options that are out there for, again, depending on the size of your business or where you want to go. Crowdfunding is still out there. Kickstarter, Fundable are the big ones that are out there for small businesses. It's a way to raise capital by individuals investing in your business. And, it takes a lot of work. It's not just you put it out there on the site, but you have to have a business plan built and put it and install it on your site. It's almost like you create your own web page within Kickstarter or Fundable. And then you try to draw through social media, through your own marketing, draw folks to that site so that they will invest in your product. They see some value in it. And that's the way that works. And of course, there's angel investors and there's venture capital based on the size, again, and scope of your business and where you're going. Angel investors, obviously, if anybody watches Shark Tank, you know what that's about. They'll invest, but they'll also want some equity capital in your business. So they'll want to own part of your business, sometimes more than 50%, so that they have they kind of take control. And venture capital is usually very large, over 250,000 millions of dollars normally. But those are out there as you grow. Hopefully, we hope some of you need this someday. But those are some of the options on the investing side that are available, are out there, you should be aware of as your business grows. And Diane, you want to just talk about this? Now, of course, we've all seen what's been going on through our COVID crisis. If Diane, you just want to touch upon kind of what's happened with PPP over the last few months.
Yeah, so the last round did close recently on August 8th. So there are no more, we can no longer accept those applications. But again, the assumption is it may come back. In the meantime, regarding the forgiveness, there is some hope that the PPP loans that are out there currently, it is possible that there will be a certain number, meaning a dollar amount, that maybe will just be automatically forgiven if it's a certain number or less. So at this point, some banks may be accepting forgiveness applications. I know we're not, and it's simply because they've changed the program so many times, and there are still some changes that are forthcoming. So you'll have to just check with your bank. That's the best thing to do. If you already have a PPP loan, just check with them.
Check with your bank, check with the SBA website. It's so important. And PPP, I just saw a quick note there, is a payroll protection program. And that was built basically very quickly to help businesses that, of course, had to basically close up or stop doing business so that they could continue to pay their employees and pay utilities and things along those lines, the very needed pieces. And there's there's other parts of that called forgiveness. We won't get into that today because it's kind of on hold at this point. But that's what PPP is for folks who have not been involved in that program.
Thanks, Carm.
Yep. So what we'll do is we're going to go through this very quickly so we can get to some questions. Almost every type of lending you can get, some banks don't require it, but the SBA does, and most of the other lenders do, is a business plan. And the reason is this, business failure rate, according to the SBA, 30% in the first year, 50% after 5 years, 66% after 10 years. So basically only 30% exist after 10 years that started today. We can go right to the next slide, Kate. And the reason for failure is, I always look at just the first one, lack of planning. And if you don't have a business plan, these other things follow. Lack of leadership, overexpansion, expenses outweigh the profits, no differentiation from your competition, lack of focus usually by the top end of the company, that there's no engagement by the rest of your organization. So those are the reasons normally businesses fail, but it's really lack of planning. The elements of a business plan, for those of you who've never built one, they're right here: executive summary, description of the company, description of what your offering is, whether it's a product or a service, the management, what the organization looks like, who does what, marketing and sales, marketing analysis, who are you going to market to, what's your demographic, are you local, regionally, locally, globally, and the financials, projections of where you expect to be the next 6 months, next year, 3 years, 5 years out, funding requests that you may need up front, which we call often seed money, and an appendix for other things like contracts or permits, things along those lines. And of course, that's where SCORE comes in. When we talk about a business plan, SCORE is extremely helpful. We send many of our members to SCORE to help them build a business plan, because it's such an important aspect. Any angel investor or any banker will tell you that person had a decent business plan, but they didn't have any energy. I didn't believe them. So it's really important that you believe in your product or service. And then when you create this document, you're able to, in essence, sell it to anybody you need to. But building the document is a experience that any small business owner should go through to understand what their business is really about. It really brings it to reality, because when you go into a business, you think, boy, I really love this particular thing I'm doing. But all the other aspects of the business are involved in order to eventually be successful. And those are some of the parts of the business you may not be a specialist in or may not like a heck of a lot. So you really learn about what it really takes to be successful. And we can go through this. I don't have to read through this, but you'll get a copy of this, marketing and sales. I'll just touch upon that for a second. It's, we talk about websites, social media, having a shopping cart on your website. Do you or don't you? The way people make payments today, we see so many more apps, right? When we go to buy food or go to the diner or to a restaurant, that you just order on your app nowadays. So there's so many different ways to market yourself compared to even just 6 months ago, or to look at the way you want to perform on a daily basis, the way you want your business to be seen, felt, and how do you want to engage your market. So that's really important. We'll move on. And these are just, again, some of the things we've talked about already. We can go right to the next slide. And the appendix is just if you have resumes for the individuals who are running the business or are key players in the business, any permits you may need, patents you may have, or or pending patents, and of course any contracts, especially if you're a wholesaler or a manufacturer and you're looking to sell to Target, to Walmart. Those are important aspects of things you need to have in order to put your plan together. And what we always say, Right, Diane? And we strongly suggest you work with your CPA, attorney, financial consultant before making any borrowing decisions for your business. There's always tax implications and there's risk implications in your business. So it's important to have a group of folks you talk to. And I always call it your support ring, your banker, your CPA, your attorney, score consultant, financial consultant. When you're making major decisions for your business, you should always be talking to them, and you should always think about every 6 months revisiting your business plan to make sure you're on target to where you want to be, where you're going, and to make adjustments to that plan.
Exactly.
Yep. And of course, the resources available to you, we've talked about SCORE. They're amazing. They're a source that we use all the time at Hudson Valley. And your local SBA office at sba.gov. You'll be able to reach out to that website and find your local SBA office, and they can help you out a heck of a lot. And I guess we can open it up, Bill, to questions.
Great. Well, thank you very much, Carmen and Leanne.
Thank
So
you.
we do have quite a few questions, and we'll fire them away here.
Okay.
Are there strategies for a new business in use to establish good credit? So are there strategies for a new business to use to establish good credit?
Again, I think earlier on I touched on, the fact that you can open up an account, put some money, seed money in there, take a loan against that account. It's a cash secured loan, and take it for 12 months. You can't, set it up so that your payments are going to be whatever you can afford, and that will help you build, business credit. That's one way.
Yep, and it's important to have your own personal credit. If you're in the midst of starting a business, make sure if you don't have the best of credit right now, do your best to build it up. Go to myfico.com or to it's called, I think, annualcreditreport.com or Equifax, TransUnion, Experian, any of those sites to help you understand how to better build your credit so your score goes up, and that'll help you along the way.
Is it better to pay in 12 months or shorter?
If you set up a term loan for 12 months, you don't want to pay it off early. You want to pay it for the entire 12-month period, and you want to make sure every payment is made on time. That's how you're going to get your best credit score.
Okay, thank you. Is the information in DUNS viewed by banks when assessing business credit?
I'm sorry, what is the question?
Is the information in DUNS, D-U-N-S, viewed by banks when assessing business credit?
Do you know that one, Diane?
Yeah,
Well, it can be.
DUNS report or DUNS,
Yeah. The answer is it can be. Every bank, let's just say this, and just as really important information, I think, in general, all banks are not created equal, okay? They do not look at credit the same way, and meaning to say they may have different policies and procedures, different credit scope. So for instance, one bank might say, well, gee, I don't want to work with anyone that doesn't have a credit score that's at least 640. And yet you might go to another bank, and that bank may say, well, we're willing to go ahead and work with someone with that credit score. So banks are not created equal in that respect. We also weigh things differently. So depending upon what company you're working with, they may be looking at various items to determine. When it comes to commercial lending, understand we're looking at a number of things. We're looking at cash flow. We're looking at loan to value. We're looking at your personal credit. We're looking at your business credit. We have to understand your experience and what you've done, how long you've done it, how deep is that experience, how many, so there's when it comes to borrowing money for commercial purposes, all of these things are taken into account, not one item or another. And I know that a lot of younger businesses and people that are new at this always think it's all about the credit score, when in fact, the credit score is a part and a piece of the big picture. So we rely on multiple items to make decisions, not one item.
Okay. Next question, does having a cosigner make a difference on most business lines?
Does having what?
A
cosigner.
A cosigner. You know, cosigners on commercial loans are a little unusual,
Yeah.
because a cosigner is really used for more, I think, consumer products. You have to, typically, you're supposed to be a 20% more or more owner of a company, and that would be called a guarantor. If you're trying to get a loan and you don't qualify on your own, but you have a friend, a family member, somebody that would like to go ahead and be on that loan, and they're not an owner, I imagine it can be done. It's not done typically, but it could. That person, though, has to realize that we really can't talk to them. So if you default, they're going to owe the money, but we really can't speak to them because they're not an owner of the company. So this is why many times people that are not owners are not co-guarantor, you know, are not going to be a guarantor on a loan, because we can't speak to them.
Okay. What is considered a small line of credit? 5,000 or 5% of annual proceeds?
You know, when it comes to a line of credit, the size of the line of credit, the question always confuses me because I get this question a lot. It's really about what you need. And you know, your need is based upon what is it, and once again, we go right back to what is the use of funds for? What are you trying to accomplish with the money? So if you're saying, gee, I have a bunch of people that owe me money and I have $100,000 worth of receivables, well then now I know how to determine the size line of credit you're going to need. Okay, so this is, you know, what is considered a small line? Well, a small line would be $5,000. Some banks won't do loans or lines of credit, you know, that are below a certain number. So once again, if you're wanting to know what the smallest line of credit you can get is, you need to call the financial institution that you're working with and say, hey, I just want a small line of credit, smallest thing I can get, just to start building my credit. What's the smallest line I can get? That's what you need to do.
And often, Diane, what we look at is in the banking world is when we say small, technically, we say, you know, up to this amount, it might be 100,000. You only need this documentation. Over 100,000, you're going to need up to 250. You need this documentation, and over 250, not only need the documentation, but you're going to need a cleanup period. So again, it's looking at not just the size, but what are the requirements and ramifications.
And every bank is different, and that's why it's really important that you check with your banker.
Okay. Is it appropriate to use an SBA 7(a) loan to help fund payroll?
Again, payroll is something that would be considered short-term use. So it's a line of credit. And if you can afford the line of credit on your own, then you don't necessarily need an SBA loan. You only use SBA loans typically if you can't get traditional financing. So SBA is there to shore up if there's a particular reason why you need to use an SBA loan. I hope that answered the question.
Yeah, and overall, right, Diane, an SBA is going to be a little more complicated than a line of credit at a financial institution. So generally, for, you know, let's say a $5,000, $50,000, $40,000 payroll, you'd probably be much better off with a line of credit.
Well, you would use a line of credit, yes. For payroll purposes, they're short-term use. Once again, 12 months or less. Certainly in this case, it should be, you know, much shorter. That's it. You're going to use a line of credit. That's the product you would use. And it could be either traditional, meaning directly with a lender, or it could be an SBA.
Yep.
We'll just take a few more here. What is the average credit score needed for a loan as a new business?
Every lender has their own parameters.
Yeah. Generally, just to throw a number, 640 is generally what you'll see out there as far as a bottom number. But again, your institution may be more open to numbers lower than that, but that's generally what you'll see out there.
Can I use my 403B for a down payment to purchase a owner-owned multifamily home?
You can use yes, the answer is yes.
Is there a program available to estimate the financial projections?
I'm sorry?
Is there a program for that you can use to make financial projections?
Well, usually that's where the business plan comes into play that Carmen spoke so much about, which is really a template. And part of the business plan are the projections and assumptions. So, that's a very critical piece, and this is why a business plan is so important. I mean, and I'm going to tell you, it's not like just new companies are the only ones that put together a business plan. When you're in the middle of, you could be in business for 10 years or 5 years and really start getting into you want to do a much larger business expansion. You're going to end up doing a whole new business plan at that point, because you're going to have to put together some projections and assumptions, because you're going to have to determine what is it that you're going to need over the next year or two in order to get that business up and running, meaning to take that next big leap. So business plans are used by companies of all sizes every single time they make major changes to their company.
And I believe SCORE would be a great resource for you if you're looking for a consultation, if you will, about where you need to go with as far as projections.
We would strongly agree with that, Carmen. Thank you very much. Yes, please, anybody interested in talking to a mentor regarding developing a business plan, please reach out to your local chapter. We'd be happy to work with you to develop a good business plan. Just a couple more quick questions here. Some are a little in-depth and more personal in terms of their, let's see.
And we did leave our, Bill, we did leave our numbers on this so that
Oh, great.
folks, if they want to reach out to us, to Diane or myself, we'll be happy to answer questions for them.
Yeah, there's a number of questions that are more personal,
Gotcha.
specifics in nature. I think probably best if those folks would. Everybody will receive a copy of the entire presentation. So please don't hesitate to reach out to Carmen and Diane.
Absolutely.
Yeah, and I would say that, even more important, if you're trying to get credit from whatever bank that you've been with, and it's important to understand that if you have a good relationship with your bank, and if you don't, wherever those accounts are, you want to make a good relationship. You want to form a good relationship. So get in there, get to know your banker, meaning get to know the branch manager, get to know who is the business banker there. I saw a question coming up, can I use my home as collateral? The answer is yes, but if you're going to do that, that would be more of a home equity and not a commercial loan, just so people understand that. So, get to know your banker, get to know the people that you're visiting every day, or maybe not as much anymore because everyone's doing everything online, but you do want to get to know those people.
And we'll take one last one here. What are some funding options for newly established nonprofits? aside from fundraising and grants, what are some other funding options for a newly established nonprofit?
Again, it always goes back to what is it that you need the use of funds for? All of the products that we talked about today, lines of credit, term loans, commercial mortgages, credit cards, these are all products that should be used as tools to achieve your goals, not as crutches. Keep that in mind. And there's a big difference. Some people think if they just get a little bit more money, they can solve all their problems. And in many cases, that is not always the case, okay? So the only thing I can say is these questions that are being asked, what can I get? The answer is what do you need it for? What do you need it for? And if you don't know what you're needing it for, then there's no way to have a really good conversation because there's so many products available.
One other thing I'd add to that, Bill, is what I find often is if your accountant isn't giving you the answers that you need, maybe sometimes look for an accountant that specializes in what you are as an organization. So if you're a non-for-profit, there are accountants out there that specialize with non-for-profit agencies and organizations. Just like different industries, sometimes their specialization fits in a certain area. That could help you tremendously, not only today, but as you build your business.
Yeah, again, you made this point during your presentation, Carmen. Again, every business owner really needs a good support team, namely a lawyer, their accountant, CPA, insurance representative,
Yep.
of course, a good SCORE mentor, and a good representative from a financial institution. So,
Absolutely, Bill, big believer in having that team that you can rely on and go to.
So again, for all those that's still on, I would strongly suggest if you have any questions, don't hesitate to send it directly to Diane or to Carmen.
Yep.
And we greatly appreciate everybody's participation this afternoon. And again, all the slides will be sent out next day or two. Thank you very much again for joining us. And again, thank you to you, Carmen, and to Diane for an excellent presentation. Thank you.
Thank you so much. It was a pleasure.
Thank you.
Thank you.